Being smart is supposed to protect you from bad money decisions. The engineer who builds financial models for fun and still hasn't refinanced a mortgage that's costing him $400 a month. And it all comes back to one cognitive bias that intelligence actually makes worse. Picture this. It's 2004. You're 26. You just graduated with honors, landed a solid job, and you feel genuinely good at understanding complex systems. When you research a financial decision, you go deep. Spreadsheets, forms, competing analyses. Your colleagues trust your judgment. Your friends ask your opinion on their investments. The system rewards your intelligence at every turn. Your brain is your greatest asset. You believe that completely. Now flash forward to 2012, same person 34. Your less educated neighbor just told you his boring S&P 500 index fund returned 14% last year. Your sophisticated multi-factor strategy, which you spent 3 months researching, returned 2%. You understood your strategy better than he understood his. That's precisely why you lost. Intelligence doesn't protect you from cognitive bias. It gives you better tools to rationalize exactly the decisions that hurt you most. Here's the first weird thing about smart people and money. High intelligence doesn't reduce financial overconfidence. It amplifies it. High-ability reasoners don't hedge, they commit. And commitment without doubt is how you miss entire bull markets, waiting for a correction you were certain was coming. A 2022 University of Chicago Booth study found people scoring highest on cognitive ability tests were 28% more overconfident in financial forecasting than average scores. Kevin, 2019, smartest person on the team, called a market correction in Q3, had been calling it for 18 months. He was right eventually. He'd missed the entire run waiting. It's not stupidity. It's intelligence weaponized against itself. Here's something that confuses behavioral economists when they run the data. Smart people are more likely to fall into analysis paralysis, not because they can't decide. They found 17 legitimate factors worth considering. Meanwhile, the simpler decision compounds for years while they research. A 2023 Vanguard behavioral research report found highly educated investors were 34% more likely to delay major financial decisions than lower-income investors with fewer options. Sandra, 2021, MBA, 3 months of spreadsheets before choosing a Roth IRA. She missed the year's contribution window entirely. We'll get to why complexity is the enemy, not the solution, in a moment. It's not caution, it's overthinking dressed as diligence. Here's a stat that surprises people when they see it. The more sophisticated your investment strategy, the more likely it underperforms an index fund. Smart investors aren't buying bad products. They're buying products complex enough to feel like their intelligence is being used. S&P Global's 2023 SPIVA scorecard found 92.2% of actively managed U.S. equity funds underperformed the S&P 500 over 20 years, bought primarily by above-average education investors. Robert, 2017, chartered financial analyst. 23 stocks, 3 ETFs, a covered call strategy. His brother-in-law put everything in VOO. Robert spent 40 hours monthly managing. His brother-in-law spent 0. It's not sophistication. It's complexity performing as sophistication. Let's talk about the skill that makes smart people uniquely dangerous to themselves. High intelligence correlates with the ability to construct post hoc justifications. You make a decision emotionally, then build a rational case for it that you believe. The smarter you are, the better the cover story. A 2021 Yale School of Management study found people with higher numerical ability were better at finding justifications for existing positions. A phenomenon called motivated numeracy. Your neighbor Lisa, 2020, wanted a second car, spent 2 hours on a spreadsheet proving it was rational, The math was accurate. The conclusion was predetermined. It's not analysis. It's retroactive permission dressed as logic. But here's the twist. Intelligence doesn't protect you from sunk cost thinking. It makes it worse. When smart people make a bad investment, they don't cut losses faster. They build rigorous cases for holding. Their analytical ability gives them exactly the tools to justify staying. Always one more variable, explaining why the thesis still holds. A 2022 Duke University behavioral finance study found high IQ investors were 41% more likely to hold losing positions past their stop-loss thresholds than average IQ investors. Tom, 2018, bought a stock at $80, dropped to $42. 3 months of written thesis defense, sold at $28. It's not conviction, it's intelligence defending a mistake. Here's the one thing nobody says about intelligent financial decision-making. Simple beats smart. Not because smart is wrong, because simple removes the failure modes intelligence introduces. Smart opens up 20 approaches. Simple picks the one history shows works, removing the chance to outsmart yourself. It's not about knowing more. It's about knowing when to stop knowing. Every contradiction in this video traces to the same flaw. Intelligence is a multiplier, and it multiplies whatever tendency you already have. Rationalize with it, and it rationalizes better. Overcomplicate, and it complicates harder. Your intelligence isn't the enemy. Your unchecked confidence in it is. Which bias hit you hardest? Overconfidence, paralysis, or rationalizing a bad call? Subscribe. Every week we unpack why smart people make irrational money decisions.